partnered with two others within my mentoring group and bought my first multifamily property. It was 86 units for a cost of 6.75 million. So we got 80% LTV in the end. So our loan amount was about 5 million. So, and then we had money for rehab on our own. So we had to raise more than $2 million. And so that's from a lot of different investors at about 50K each, right? Is the minimum investment to raise that money. So me and my two partners, we raised that money. We did the underwriting of this property, and then we closed on the sale. And surprisingly, even through COVID, this property is performing very well. But that's because of a lot of education and coaching that we were able to find this property. So yeah, it is very easy to find the wrong property in the wrong location and make mistakes and lose a lot of money, right? So some people make it seem like, oh, it's easy. Everybody makes money in real estate and multifamily, and that's not the case. The case is that the more education you get and the more local experience you have in that market, there is never a shortage of experience, right? Make sure you connect with the right people. Like Emma is great in real estate and has a strong background. She's starting to do multifamily. How many have you done so far, Emma? You've got one in Arkansas, right?
Multifamily units, I think total doors is 88. So we got 2 buildings in Arkansas and 1 building in Idaho. And we just this week put 60 units under contract in Salt Lake.
Congratulations. So see, she's got 3 different locations and multifamily properties. So now if I had to buy a property in any of those locations, she's going to be my first point of contact for local information, right? Because I can look at financials of any property and try to underwrite a deal, but nothing can beat the local experience of someone who's actually managing an asset in that property. So you definitely want that. You need local partners. So that's a very big piece of it. So once you pick your target market, whatever that might be, try to network with people who are locally invested in that market. That's the only way to do it, and to scale up. So you each have your primary roles, but generally everyone helps with all of the aspects of it. So I see multifamily investing as 3 prongs, right? The first prong is to find the deal, to have the broker relationships, to be able to underwrite the deal and find a deal that fits your criteria so that your business plan can be executed to make money for you and your investors. So again, I'm talking about larger multifamily that most of us don't have the money to go and buy ourselves. So even to put that down payment for your loan with Freddie or Fannie, you're going to have to raise income or raise money from passive investors. So that's the kind of typical deal that I'm talking about. So the first part is underwriting and finding the deal, really doing your homework on the deal, which is comps. What do I mean by comps? I mean comparable properties very close to your subject target property. So on the same street, on the same side of the highway, very similar in amenities. So we say Class A properties are pretty new properties. Class B is mid-80s and up, and then Class C is older than that, as far as the types of properties we deal with. So you want to make sure if you're interested in looking at a Class C property, you don't compare it to a Class A property, right? And vice versa. So your comparable properties have to be close together within the same distance, and you have to justify every financial number you place in your underwriting by looking at these comparable properties, right? So if the property next door, people are willing to pay extra for reserved parking, or they're willing to pay $100 extra if they have fancy countertops and stainless steel appliances, etc., what are they willing to pay that for? You really have to look at your comps to justify that rent increase. So every financial item that someone looks at in an underwriting has to be justified with actual real data as much as possible, because then you're reducing your risk. So in COVID times, which is the next 12 months as I see it, we may be over COVID to some extent, but then there's the recession or some level of impact that COVID has had because so many, businesses have been shut down the last 6 months. We have an uncertainty with the election and what's going to happen next year. So if you're underwriting any new property right now, I would definitely assume no rent bump the first year, unless the comps can justify it. You have some new industry coming up there or new businesses in an industry that is going to thrive under any condition, right? Because there could always be a mass exodus of people from a location because now more and more people can work remotely. They don't need to quite live in that downtown area in that apartment in close proximity. So make sure you understand all of the local market conditions, the job and population growth, the median household income that can support the rent bumps that you are planning. A lot of it goes into this underwriting at the beginning to make sure you're not making a big mistake in taking on this property, because you are paying a lot more for this property compared to what the seller had paid a few years ago for it or many years ago. So you have to now be able to justify the cash flow from this property to be paying that high price and then paying the property taxes at that high price, the insurance, and all the other expenses that go with running a property. So the first piece to acquiring a multifamily property is that very, very thorough study and underwriting and finding the right deal. Now that you've found the right deal, the question is the broker going to give it to you, right? If you're brand new and you don't have that broker relationship, you may not get awarded the deal. The broker might feel more comfortable awarding the deal to someone that he or she has already had experience with whom they've closed a deal, because the last thing they want is for you to be under contract and then for it to fall through and to start over again, right? They want that deal closed as soon as possible. So that's one piece of it. The second big piece of it is to raise the capital that you need to afford this deal. And usually the capital raised folks, whoever is the primary role on that, tends to also manage the investors because they probably brought in the most of the investors. So that's another big chunk of it. And the third one is when rubber meets the road, it's time to manage this asset and execute your business plan. So for that part, you need experience again. If you've never run a property before, right? The very first time, like for me, I partnered with people who had done it before because I wasn't going to take a chance with other people's money. I mean, the lady down the street invested in my property because she knows I'm an engineer. I have good math skills and I'm going to be on site of the property, et cetera, et cetera. And all of that is great. And she knows where I live, so she can come and just, shake my head and say, where's my money, right? So she invested with me because she's known me for a long time. But at the same time, that's different from being able to run an apartment, something I hadn't done before. So I needed the experience of my partners to kind of show me the ropes, if you will, and say, okay, this is what we agreed to do in the business plan. Okay, so let's go execute that, right? So I felt very confident after we had done a couple of the projects and saw the actual rent bumps justified or the money coming in, that this is great. But for a first timer, I would say, yeah, your duplex experience, quadplex, all of that is going to teach you some. But now you get a little more hands off, right? When you have a third party property management company. So you can still use a lot of the same KPIs. But now that it's scaled up a little bit, you're talking 80, 90, 100 units plus. How can you manage that relationship so that you get what you need from your property management company to effectively control your expenses, make sure they meet your pro forma numbers, right? And the best way to do that is make sure they're involved in the budget and in the whole expenses, everything in your underwriting up front. So before we sign a contract, we make sure the property management company we have hired for that location agrees to these numbers. So if they said, oh, you can bump your rent $100, we're like, okay, how do I justify that? Well, you have to do this and this and this. And so you all agree on that business plan before you sign the contract. And that way you're all set as far as, holding them accountable and making sure you get at least weekly tracking. And in some cases, we watch the numbers closely on a daily basis, sometimes through COVID, you need to be able to log into their system and monitor the things and get the reports you need from them. So again, the three big pieces: finding the deal, underwriting it, et cetera, and then closing the deal by raising enough capital, and then asset management. And as you can see, asset management is what takes the longest, because from the day you close the deal till it's all done, the asset manager has a very big job to do there to execute the business plan. So you definitely want some strong people there. But now that I've done it, I've seen it done, I feel pretty confident. So I'm in a joint venture with some others. I've partnered with others on, so far now, this is my third deal. So I stick to the one market that I'm really familiar with, which is Dallas for me. So in that sense, if you want to get into multifamily, I say, it's easier if you just stick to one market and do more and more and more business there. But then some folks also like to diversify by having properties in multiple markets. That way, they mitigate their risk because you have floods in Houston or you have wildfires in California. You never know what could happen. So you don't want your two properties right next to each other or something. And others say, oh, have it next to each other. That way you have, you can save money in the economies of scale with your property management and a lot of other synergies. So I don't know. I'm still sticking with the one market that I know because um, the kind of knowledge I would need to get up to speed on in some other market is pretty high. And I like to be hands-on with my properties. So let's say I invest in a property in North Carolina and I know nothing about that market. I don't feel comfortable raising money from passive investors and not being able to tell them my own personal knowledge about it. I would just be doing hearsay from my partner who's out there. So I think each person, you have to know what you're comfortable with, what your threshold is. A lot of people like it that way because, at 60 days, once the deal is closed, it's more for them on email support and calls and things. They don't have to be the ones to go on site and execute as much. So their time is more freed up. And a lot of people like that. So you kind of have to see between these three parts, which part do you want to do and fit in the best, right? And learn that and really become an expert on just that one thing first. And then you choose partners who can fill the other gaps so that as a team, you have all bases covered. And that's how I've seen it done in my last couple of years of being in this business, being involved in multiple groups. I've seen that's a pretty common trait to where people become experts first at one thing, and then they form teams, and then they, start growing their knowledge in other places. But you want team members with complementary skills, and you want to make sure your underwriting is conservative during these COVID times to make the business plan work. And ultimately, your goal is for your passive investors to keep coming back to you, right? You don't just want them to have a buyer's remorse saying, man, I wish I had never invested with that person or in that deal during these times. So I try to underpromise, overdeliver is always a good philosophy. But let's have some discussions because I'm not the only one in this business. So I definitely want to hear from the others in this business.
I have a question for you, especially as it relates to kind of transitioning your stocks, profits, your gains really over into real estate. So the first question is, how much are you still investing in stocks actively? And the second question is, how has that helped you to be a passive investor in real estate, and then you kind of moved from there into being an active investor?
So I wanted to learn the business of multifamily investing, and I had got my knowledge from videos, mentoring programs, and textbooks. But for it to become practical knowledge, the best way for me was to invest passively in someone else's deals. And by doing that, I don't take on all the risk and the work that a sponsor has to do, but I get to ask all the questions I want and learn from it. To do that, my retirement funds were perfect for me because real estate is not liquid. So you don't have access to that money 6 months later. These are more 3 to 5 years or longer term kind of projects, right? So that's the typical cycle time. So I wasn't counting on my retirement funds to be available for me for a while. So I could take the retirement funds and invest passively in other people's deals because you're not allowed to put your retirement funds into your own deal that you manage and run. So in that way, passive investing with those made sense. And that got me invested in real estate instead of the stock market with the retirement funds. But I still have a portfolio that I still believe in the stock market, as crazy as it is, as paper and volatile as it is. I like the liquidity that it offers me. So I make sure I always have 6 to 9 months of cash reserves that I need for all of my expenses. If all of my sources of income stopped, how long can I sustain myself kind of question. So always 6 months is a good idea to have that and have it in a very liquid form somewhere. And then you decide what you're comfortable with, right? Like for me, 20 years in the stock market, I still like it and I still invest in it. But I'm now diversifying to where my retirement funds used to be all in the stock market, and now it's in real estate. And when I do my own deals, I use I use my regular income, non-retirement money for my real estate deals that I sponsor.
Okay, so when you're moving, so your stock portfolio in your retirement income, I'm assuming you transferred all that over to be a self-directed retirement account so that you could invest it into a real estate deal. And so when you're pulling money out of the stock market in your regular portfolio, your cash portfolio, do you do that? How are you able to offset the gains from your cash transactions or your ordinary transactions? I know that you can put it in an opportunity zone because you can take the gains from any source and invest it into an opportunity zone to have that offset. But can you offset that in another way, or do you have to invest it in your own real estate deal? Are those capital gains offset in that way from the depreciation? Is that how it works? Or kind of walk us through how that works.
To the Trump tax law, we have this beautiful thing called cost segregation and bonus depreciation. And you are allowed to take all of that in year one rather than across, say, the next 10 years or so of the life of that equipment. So your air conditioning can last 10 years, but you can take depreciation of all of your equipment, etc., in year one. And you can do that every time you buy a property. So let's say you're buying a property next month and you're able to close and get the keys, so to speak, before the end of the year. So even if the previous owner did a study and took their own depreciation, you get to do that as well as the new owner and take it for this tax year. So that's a very tempting thing to do. So what we do is on a quarterly basis, I look at my portfolio, I look at my gains, losses, etc., and I try to make it so that somehow I get closer and closer to paying lesser and lesser in taxes. So I balance that against my stock gains, my spouse's W-2, etc. And then I say, okay, how much depreciation do I need this year so that I pay the least in taxes? And so I was paying a lot about 2 years ago. Last year, we cut that in half. And I'm hoping to reduce that a little bit more this year. So that ultimately, if President Trump, who's one of the most wealthy people I know, pays zero taxes, companies like Amazon pay zero in taxes, and in fact get some relief from stimulus package and all these things, why should I be paying so much in taxes? Because I'm still providing taxes because all of my properties, I'm paying huge amounts in property taxes. So somewhere my money is being taken and paid as taxes. So my goal would be to pay less and less and less. And this is the way to do it, is cost seg and bonus dep, because we don't know how long it'll last. We don't know what's going to happen with the election. But I see that whether Trump or Biden wins, all of us are going to have to pay more in taxes. So the more ways you can find to reduce your taxes, and that's usually, if you know what is that quadrant, cash flow quadrant, if y'all are familiar with that, generally you need a business or you need real estate to reduce it. If you just have a good, regular, high-paying job, doctors, lawyers, etc., they're the kinds who pay the most in taxes. So you need business or real estate to somehow find a way to keep reducing your tax bill.
I have another question for you about those of us with a W-2 spouse. So two things there. I've noticed that the high-paid W-2 or business owners, like say the doctor, lawyer that you mentioned, a lot of times what they'll do is they'll have their non-working spouse become the real estate professional on the taxes. So they're the ones helping to manage the investments. You have to be spending roughly 750 hours, at least 750 hours a year, managing those investments. They can be passive. You don't have to be an active real estate investor. You can be just managing passive investments. So they'll designate the non-working spouse so that they can then take that extra depreciation across to offset the ordinary income of the working spouse. But what we've found now that I'm the real estate professional active, my husband's W-2 income looks like this now. And getting a mortgage for ourselves has become very difficult. And so where it used to be, we could go out and get a mortgage, his income is looking worse and worse. And so have you found that to be a case if you want to get a new mortgage for your personal home, how you've been dealing with that? Do you have to pay?
We haven't had that happen yet because we haven't looked for a house. But I have signed like 4 loans so far that are in the millions. I think my last loan was $28 million. Another one was $12 million and so on, like really large amounts of agency loans, Freddie and Fannie. And so they use the fact that you're in one loan and you can't even afford $28 million, let alone the next $12 million. That doesn't seem to affect them at all. But yes, it doesn't really reduce our income per se, but it reduces your overall tax burden, right? So you can still show your husband's earnings and paycheck from his employer to use that for credit. At least we haven't had that problem yet, but we haven't gone out to seek a mortgage on our personal side because we've been in the same place for a long time. And certainly credit cards haven't been a problem, or high limit credit cards haven't been a problem. I can tell you that. But yeah, we haven't had to go seek a family mortgage yet.
Hey, Emma.
Yeah.
Are you using a broker that will add that depreciation back in? Because when I've bought lots of primary residences, and I just make sure that they add that depreciation back in, and I've been okay.
That's what we're trying to do right now, because we are buying a personal home right now, and it's been interesting to go mortgage shopping for that with just the 2018 taxes. Our 2019 are just coming through, and it's going to be even worse. So I was just wondering how people are running into that and how you're offsetting that. I know business owners, self-employed business owners, sometimes will take the hit of declaring more income and paying more income tax for a year or two so that they can get a mortgage, and then they go back to taking the full deductions. And I mean, obviously I don't want to do that. So I'm curious if you run into that problem or how, because we can sign on, like Sandhya was saying, $28 million loan on an apartment complex, and because they be the experienced partner to help secure the loan. But we're starting to have problems getting a personal mortgage. It seems kind of ridiculous. So we're just looking for a broker who understands investing and the way around it, and help us be creative in the way we get that. But hasn't been too much of a problem yet. But I'm just wondering if it does turn into one eventually.
I think all lenders across the board are tightening their requirements, whether that's agency or mortgage, as more and more people are starting to default on their loans. Lenders are getting more picky about what loans they will grant. So in terms of, I don't know, multifamily, depending on who you listen to, like Grant Cardone was very bullish, right? And that's how he is about multifamily. But he was saying at AIMNetCon last weekend that as you get more and more people not able to pay their mortgages and getting out of their residences, there are going to be more renters. There's going to be just a lot more renters in general for various reasons. One is not being able to afford a house. And then the other part is just lifestyles. People just don't want the responsibility, whether that's seniors or millennials, they don't seem to want it. So there's always going to be a demand for housing. If you pick it in the right markets and the right class of asset, it's going to always be a need. Now, granted, if you buy something today and you have to sell it in a year, that may not be as great an idea. But if you're okay with holding it for 3 to 5 years and you're able to underwrite it well and pick the right places, multifamily people are still very optimistic about it long term.
Also, one of the things that I just wanted to mention is, at least in my opinion, is that working from home is becoming more routine. And because of that, I think people are really looking into, their primary residence. Before that, it was just like one bathroom, one bedroom to just, live in there, just sleep and just, wake up and go to work. But right now, that at least I know a lot of tech companies, even Walmart, we haven't been in the office for the last 7-8 months, and it's not going to happen anytime soon. So because of all of this, it seems like probably commercial properties might be in a little bit of a new situation, but at least in my opinion, for residential properties, there's going to be even higher demands, because now you want to feel comfortable in your home, and probably larger homes actually could be a better niche. At least that's what I think.
Yeah, as long as renters can afford it, right? Because a lot of the renters we have in our apartments, we're barely able to qualify to being in our apartment. So I can't see them having any more capital as lenders get picky to be able to afford that house. Now, supposing it's folks like you or my husband, etc., who haven't lost any of their regular income because of COVID, it's a different situation. But as hundreds and thousands of small businesses close and people are not able to pay their mortgages, that's the other flip side is, I don't know how that's going to hit us as apartment owners in terms of renters being able to pay rent, but I definitely see the overall population number of people needing to rent rather than own definitely going up a little bit in the next 24 months for sure.
And another thing I didn't really consider when COVID came is the baby boom that's coming, because people are home together more often. But the other thing that we're getting is the divorce rate a few more people divorces and having to split their households. And so you're seeing people who need an extra bedroom, and then you're also seeing the households splitting up and one parent needing to move out and going and renting an apartment. And so I think that this is why multifamily tends to be recession resistant, because when things are going poorly in the economy, more people tend to rent, and more people tend to rent up to what their income can bear. For example, the house that we're buying, I'm not expecting too much of a problem with getting the mortgage, because we're actually downsizing, and people think that we're crazy. Like, why are you buying a smaller house? I thought you're supposed to be a real estate investor and go and live the life of luxury. So people are kind of surprised that we're trading down. That's very unusual, and that people live at the edge of what they can afford. And so, like you're talking about, the people in your apartments, they're not able to go out and get anything better. They're like, oh, I'm going to go buy a house now, because they're already renting at the max of what their income will allow. That's just what we tend to do. And so as the households are beginning to divide more because more babies or more divorces, we're going to see increased pressure on those apartment communities.
I see at least one new name, David. We haven't heard from at all. Do you want to introduce yourself or tell us about your investment experience, background?
Rosie, you're muted.
You want to hit the red?
All these different, how are y'all doing? All these different Zoom and different Hangouts. Nice to meet y'all. So I know Emma through some other like masterminds we're in, and I was in Corey Peterson's program over, going on 2 years now, I think, almost, year and a half. And I was in the single family business, fix and flip, for quite some time. And I think Patty's on here. I see Patty over there. Patty Royster and Dave Royster are a partner of mine on a deal that we closed on December of last year in Tulsa, Oklahoma, 107 units. So it was our first deal. Thank you. Yeah. So, it's been a challenge, but we got through COVID and all that. So it's been really, really fun. I think we just crossed almost a 95% threshold line. From when we closed on it, we were at about 59% occupancy, went to 95. Yeah. Crazy. So yeah, as of today, pretty exciting. So now we're in the, we'll start cracking out on expenses and hopefully start making a little bit of money at the place. We're in a cash out refi probably sometime, I don't know, first quarter next year, something like that. So
that's exciting. And if I can be nosy, may I ask what kind of debt you assumed at that kind of occupancy when you bought it?
We did so we bought it at 28 a door. And there was a gentleman it was an off market deal. He was sick, obviously, we all heard those stories. And we, it was a lot of Section 8 and Oklahoma housing. People that just were not paying their bills, and same old. A 1-bedroom, I think, was going for $475.
Wow.
And we're now charging $640.
Oh, excellent.
So we bought it at 28 a door, about 3.1. We raised about 975, and it was a bridge loan. So 24 months interest only on a bridge loan. Excellent. And so 9 months into it, we're already starting to hit those. We got to carry it for 1 year with our lenders. Got to go 12 months. So December 10th will be 12 months. So we want to start showing. We want to increase the NOI, obviously, so we can get a better refi number. But I would think right now, if I had to guess, we could probably be somewhere in the 5.5 range, 5.3 range. So
that's excellent.
We want to hold it for. We'll refi it out and hold it for. If someone brought us a crazy offer, I think like all of us, we'd probably sell. But I think it's going to be a good cash flowing deal for us. And going into it, everybody told us to stay out of Tulsa. It was just like, get out, don't do it. And so I think I kind of went against that myself. And now when Tesla almost went up there, Tulsa's now really, Tulsa's a really good market. Oklahoma's becoming a really good market, but Tulsa's really happening. So
yeah, and I think like even though it was a second choice for Tesla, if they need another factory, it's gonna be with their
yeah. I think you're right. They could open that door.
I think the next time it'll be there. And also, I was wondering, are you considering a HUD refinancing? HUD loan for your?
I talked to a gentleman about that, And I think we could. I just think of the time frame. I know they've sped the time frame up from like 6 months, 7 months, 8 months down to that 6, 5, 4. There's some people who do it in 4 months now. I think some of the things have changed. So we're looking at all different options. I think right now we're just focused on getting past December, maintaining the 90% plus, increase in the rents. We're still working some of the. We got a lot of the Tulsa or the Section 8 out of there. That was our model, right? We're not against it. We just it's just kind of the decision we made to put a different crowd in there. Believe it or not, we are surrounded by. We're in between a country club. If anybody's a golfer on here, called Southern Hills Country Club. Like we literally butt up next to it.
Wow.
$1 million homes all the way around us, which is crazy.
That's a phenomenal location.
Yeah, it is. It really is. So we're excited. Now we're just looking for more. And, I'm out there. I love to underwrite. I love numbers. I think I'm a pretty good number guy, but I like to underwrite.
Awesome.
And I like to market. So.
Well, I'm in Dallas, so it's a 3-hour drive.
Wow.
Half of people from Dallas go to OSU, and so I know.
I'm in Trophy Club.
Really?
Oh, yeah, I'm not far from you.
Oh my gosh, I'm in Richardson. We got to meet outside of.
Yeah, definitely, absolutely. There you go.
Yeah, this is awesome. So, does anybody else have questions you want to talk about as we get close to our, wrap up time? Do you want to give everyone's contact info or anything, Emma, and connect us if anyone has questions or wants to do any deals in Dallas or Tulsa, but select locations in Tulsa? Let me know.
Yeah.
Got somebody right there, and you got other locations. Absolutely. Emma's the expert on some other locations and so on.
So, I love it.
That's how we met Pasha, because we were looking in Little Rock and Amy was like, hey, I know you need to meet some Arkansas people. So we're starting to check out people, but that's how you get it done. Okay, so if you want to put your contact information over in the chat on the right hand side, we'll save it and I can send it to people privately. Sorry about the bad sound quality. And then we can connect in the passive investing, passive real estate group on Facebook.
Please go away.
And continue to network over there. So just pop your information on here, and you can put your specialty, the cities you work in, or what your goals are, what you're looking for, whatever you want people to know about you, and pop that in there, and we can kind of get to know one another. So I think I know most of you guys in here, but I don't know if you don't all know each other. So anyway, we meet the last Thursday of every month. We've been meeting now a year and a half, I want to say. So we are going to continue to meet for the next year and a half. We were meeting in person, but since COVID, we went online. And so I'm going to go back to in person in the next couple of months, but we're going to continue to do live casting once we go back to in person. And then would love to have you guys join us again next month. And next month, we are going to be talking specifically about security for passive investors. So wire fraud, how to protect yourself with your laptop now that you're handling large amounts of money, either whether you're a passive investor sending it or whether you're an active investor giving out instructions and accepting it. You guys now have lots and lots of sensitive information on your computers with your deals and your investors, and we're just going to learn about some basic IT stuff and some banking security to keep your money safe. So we're going to be having some people who have done it right and who have also done it wrong to kind of come and teach us what they learned about how to keep those transactions and that information secure.
Thank you. That's going to be very useful.
Yeah. So, all right. Thank you for coming, Sandhya.
Thank you for having me, and this was nice. I had to come to Salt Lake City to meet someone in the Dallas area. That is great.
Awesome. Please reach out.
Yeah, thank you.
All right,
thank you. Thanks, Emma.
Troy just walked through and yelled, "Hi, Sandhya." He's like, "Oh, you got Sandhya on there." So,
hi.
All right, we'll see you guys all next month. Thank you for coming.
Thank you. Bye.
Thank you all. Bye.